Hi everyone, squinting here in the London sunlight, which you can't often say, but beautiful day here. Wimbledon's on, England, Australia cricket. We won the third test match yesterday, so it's going to be a great cricket summer. And back here behind me in Hyde Park, we've had Bruce Springsteen this weekend. Previous weekend it was Guns N' Roses, and prior to that it was Pink. And there is a lot of American tourists, and as you know, jet fuel demand is really raging at the moment for this summer, although our view is that the awkwardness of flying at the moment, because it's not a great experience, everything's so busy, combined with the expense, will probably temper growth in jet fuel for now. And of course, as you know, jet fuel is 8 million barrels a day in total, with global oil demand of 102 million barrels a day. We're much more concerned about distillate and petrochemicals and the effect it's having on NGLs, although we do, of course, understand the benefits of strong jet fuel markets. Okay, so last week was interesting. We had a huge move on Friday. Schlumberger did 9%-ish, which was a 5 standard deviation move, as people reposition. And it could be very interesting if the market's now buying back into inflation, because of course the first half was characterized by the market buying long duration, which is basically artificial intelligence. We just wonder whether or not the move here was a little bit of the market pricing back in inflation. And one of the things we highlighted yesterday was the US housing market is now recovering. A lot of the leading indicators are looking good, and that's a problem for the Fed. And as you know, the oldest line on Wall Street is "don't fight the Fed." So there's two views. One is of the bullish, somewhat contrarian view that basically we're going to have a no landing in the US. There's no real major sign of the end of the UK economy around here. Things are not great, but you have one thing we always highlight is such great civil services in some of these countries like Britain, that things will just sort of stumble along without any great economic growth. We're not looking at major depression. We'll see, and it's always difficult, of course, to judge from central London, where basically it's all tourists and rich people. But generally speaking, things seem fine here. Anyway, the bigger view is going to be that the Fed is going to have to do a lot more to crush the economy, and you don't fight the Fed, and that's where you end up pretty bearish. The move, of course, in oil was helped by a significant run of bullish news flow in the oil market for the crude market, which was the Saudis extending their cuts originally announced for July and are now going through August. And then of course Russia saying, yeah, we're going to do more, which is, you know, the government just lies, so who knows. But the satellite trackers believe that Russian refineries are going to start running again, which is going to fit our theme, which is that you may see upward pressure, arguably artificial upward pressure on the oil market from the likes of Saudi, Russia, but they're going to be running refineries more, so you'll get more product exports. And the third element that was bullish last week was the massive explosion in the Cantarell complex, which took out at one point 750,000 barrels a day of oil, which is obviously a lot. We think anything above 100,000 barrels a day is material. And the length and depth of that outage in Mexico is not well understood. Just in terms of the fact that they did a lot of precautionary shutdowns, which now presumably will restart. And on some numbers, they've recovered 650,000 barrels a day of the lost 750, but it's very uncertain as to exactly what's going on there. Hey, welcome to the oil market. Anyway, we also, by the way, highlighted that Sudan has got some issues with the US Secretary General saying that there's a full-scale civil war, to which I thought was, I thought there really was a full-scale civil war, but basically there's some outages, relatively minor. Sudan does about 150,000 barrels a day, but they may have lost 20 or 30,000 barrels a day. But one thing we did highlight is that oil is delivered into the Red Sea, and that's where the overhang of Saudi crude has been amongst the tankers. And Kepler again is saying that the Saudi tankers are clearing. So it looks short-term quite bullish for the oil market. We're not in the crude market, but we're concerned because we believe that the Russian impact on crude markets, the Mexican impact on crude markets is bad for refining. And of course that ultimately becomes bad for the oil market, because essentially you artificially raise the price of oil at a time when demand is clearly weakening, particularly in distillate. And of course petchems, which is feeding through to NGLs. And that all feeds through to the major corporate news flow of last week, which was extremely negative. So the Schlumberger move was against a negative backdrop, which was two things. One was well reported, which was Exxon's quarterly 8K, which gives you profit guidance. It's a huge range basically, but they show you what the range is on any line item in their earnings, and we think that range is actually $3 billion high to low. But if all of those come in, they're going to miss by 30% versus consensus last week, and Exxon performed just about as poorly as, well actually it's not true, but basically Exxon was very negative last week relative to the Schlumberger move for sure. We're still seeing people want to buy offshore drilling, which sort of fits the theme. But broadly speaking, it looks like it's going to be a tough earnings season for the E&Ps, and based on this view that NGLs have been very weak, and we saw that in the Exxon earnings. Exxon was also highlighting weakness in refining, and of course petchems is just not good. In fact, it's kind of heading towards the lows that we saw in COVID. The other less well publicized, in fact you can't read about it on Twitter at all, profit warning last week struck a lot of the London clients, and that was Repsol, the Spanish major oil, which said they had $6 refining margins in Q2 in Europe, compares to $30, $28 last year. So there's a real big slowdown here, and you can see that in refining margins. Asian margins, European margins are weakening a lot, and as the crude price is being driven up, the margins are just coming down because the demand strength is not there. But of course in the US you still have the demand strength, and it all becomes an argument on basically how much the Feds are going to slow down. The Fed is going to slow down the US economy, which we think they're going to have to, and that becomes pretty bearish. But particularly we're nervous about buying the oil stocks into what could be a rough Q2. All right, so that's kind of about it. The note I sent you yesterday goes into some Mexican stuff, and basically is saying that we don't really love the idea of buying, certainly not the companies, into these Q2 earnings. They don't start next week. We have Citi and Delta and a couple of somewhat significant names, but not a lot this week. Big inflation number, which will be key. And then next week we'll start the oil earnings with the usual suspects, which is going to be Kinder, which should be fine. But then our view generally of the services is they always promise the best outlook ever and then don't deliver on the earnings, and the earnings tend to be fairly predictable. So watch out there. But it's not really the services that we're worried about, it's the E&Ps, and from where people are hiding, refining we think gets negative from here. Okay, I got positive feedback on talking about herbs last week, so I'll show you. There's a mysterious American billionairess lives next door, and I just thought you would appreciate her olive trees and annuals. All right, have a great week.